What we are going to look at now is learning objective number 6, which is the lower of cost and net realizable value rule, or NRV for short. This is a very important rule in retail business because this relates to how to determine the cost of the inventory that we report in our balance sheet at the end of the period if there are any movements in the value of that balance sheet throughout the period to the end of the period. Okay, so sometimes inventory values increase and sometimes the value of that inventory decreases, right? So inventory can be exposed to movements in prices. So for example, oil prices, as you know, have decreased quite significantly over the last few weeks. And if you drive past a number of petrol stations, most of them should be well under $1 a litre per fuel. So I've seen the cost of E10 between 85 cents per litre and 95 cents per litre, which is certainly a lot less than it was at the very beginning of the session, which means the cost of inventory on hand that oil companies and oil retailers are holding is certainly a lot less than it was a month ago. So what we're going to look at now is a method that is going to help us account for changes in the value of inventory and how we report on the value of inventory in our financial statements. Now, following the conservatism principle, we apply this what's called lower of cost and net realizable value rule. So as you know, with the cost principle, inventory should be recorded at cost, which applies for assets generally. The cost we pay for those assets is what we record them at in the books of the business. However, because of the conservatism principle, we don't want to mislead financial statement users as to the value of our inventory on hand. So if the value of the inventory on hand does decline and does fall below what we paid for it, then we need to report that lower inventory cost. And this is following exactly what the rule says. It is the lower of cost and net realizable value rule. So if the net realizable value declines below what we paid for it, then we need to report that lower value. So this is applied at the end of each accounting period. So that's when we apply this rule. So it's following an accounting principle, so Australian Accounting Standards Board 102 inventories does not allow decreases in one category to be offset against gains in another. So that means that if some inventory items decline in value, then of course, following this rule, we need to reduce the value of those inventory items. If some inventory items increase in value, we do not report that increase in value. We keep those inventory items at the cost we paid for them. So when applying this principle, you either apply the lower of the cost or the net realizable value. You don't offset one lower value with one higher value. It's simply the lower of cost or the net realizable value. So based on this particular rule, can you please answer this question? So it says an antique dealer holds the following inventory: a lampshade purchased for $100, currently worth $140. A table purchased for $80, currently worth $50. So this business, the antique dealer, is closing the books of the business for the end of the period. It wants to report on what the assets are for the business, including the inventory assets. So what is the value of inventory that they should be reporting in their balance sheet as at the end of this particular period? Please select which answer is correct. So remember, when applying this rule, you choose either the lower of cost or the net realizable value. So in the lampshade, they purchased that for $100, but it's currently worth $140. We apply the lower of cost or net realizable value. In this case, the cost is the lower one, so we go 100. For the table, they purchased it for 80, that was the cost, but it is now worth 50. So therefore, we need to apply the lower, which is the net realizable value. So the value of inventory that this business should report in the balance sheet is $150. You simply select the lower value in each case. For the lampshade, it was the cost. For the table, it was the net realizable value.